Trump's merger curveball, Upstream oil and gas shakeup, March 2025. Folks, let's cut through the noise. I'm Mark Roach, a guy who's seen the oil patch from the rigs to the boardrooms, and I've got the straight dope on what a wild twist shaking upstream oil and gas is happening right now. Picture this, the Trump crew, fresh in office, just threw a curveball, keeping Biden's tough merger rules instead of torching them like everyone expected. Wall Street's jaw dropped, and the upstream sector's feeling the heat. This is your rundown on what it means for the folks drilling the black gold and pumping the gas. Let's roll. Merger mess. Biden's rules stick. Here's the scoop. Biden's team rolled out merger guidelines in 2023 that were like a chokehold on big deals. Lower HHI thresholds, fancy talk for market concentration, mean regulators can eyeball smaller mergers and say, nope, too cozy. They're hawk-eyeing serial buyouts, snapping up young competitors, and even how deals hit the roughnecks' paychecks. Efficiency claims? Good luck. Those don't fly easy anymore. It's a tougher sandbox, and Trump's squad just said, we're keeping it. For upstream oil and gas, this is no small potatoes. Exploration and production live on consolidation. Big fish swallowing minnows to grab acreage or rigs. Think Permian Basin, where giants like Exxon and Chevron bulked up with billion-dollar deals. Biden's rules already spooked some plays. Market buzz says that deals just can't get done now. Trump holding the line means that chokehold stays tight. Companies tighter with cash than a driller's grip on a pipe wrench are rethinking every move. Upstream impact, the rig reality. Let's zoom in on the patch. Upstream's the wildest west of oil and gas, finding it, drilling it, pumping it. Mergers are the lifeblood when prices dip or wells dry up. But these rules, they're like sand in the gears. X social media post from early 2025 pegged a 30% drop in merger action in January compared to last year. That's real. Megadeals over $10 billion are on ice. Why? Regulators aren't just counting barrels, they're digging into labor impacts, innovation, and market squeeze. Take the Permian, king of U.S. shale. Last year, Exxon snagged Pioneer for $60 billion. Chevron nabbed Hess for $53 billion. Blockbusters like that, tougher now. Smaller outfits, say a scrappy driller with 50 rigs might get nabbed, but the feds could cry anti-competitive if it nudges market share too high. Production steady, 13.3 million barrels a day per the EIA, but growth stalling. Fewer mergers mean less cash for new wells. For you, gas prices hold at $3 to $4 a gallon, but don't expect a flood to drop them. Jobs? Stable, but not blooming. Fewer rigs spinning up. Wall Street's wobble, bankers sweat. Wall Street's reeling and it trickles upstream. Goldman Sachs, Morgan Stanley, those suits banking on M&A boom under Trump are eating crow. They figured they'd unleash a deal frenzy, but nope, it's a chill wind instead. Profits are dipping, less merger paperwork, less champagne. The ex-social media chatter in February griped about uncertainty killing applications. Some outfits just shelved plans. Why roll the dice when the FTC's got a magnifying glass? For upstream, this is a double whammy. Big banks grease the machine, financing deals, floating bonds. When they're spooked, the money slows. Private equity too. Those sharks circling for distressed assets are swimming small circles. The shifts to baby deals or organic growth. Drill your own patch, not buy somebody else's. It's like telling a wildcatter to settle for a garden plot. Production won't tank, but that shot of adrenaline on hold. The policy pulse, Trump's play. Here's the head scratcher. Why did Trump keep this? FTC boss Andrew Ferguson says it's about stability, no whiplash between administrations. Well, I'm calling it like I see it. It's a pragmatic grab. Trump's drill baby drill vibes love oil, but he's not blind. Antitrust got bipartisan juice now. Scrutiny on banks and techs bleeding into energy. Plus workforce focus. Those guidelines poke at wages. Fits his blue-collar pitch. Upstream feels the squeeze, though. Consolidations, that's about how you scale. Grab a rival, boost output, cut costs. The EIA says we'll hit 13.7 million barrels a day by 26, but without mergers, it's a slog. Alaska's $1 trillion gas stream from March 6th, well, that's a buzz on X, the social media platform. That's a lifeline. But if it's a merger play, say Conoco snagging a partner, it's under the microscope. CCS like Baker Hughes, March 5th move, might dodge this. It's tech, not market share. Still the vibe's clear. Grow smart, not big. The Roach take? Straight talk. Here's the raw truth from the trenches. Trump keeps Biden's merger rules. It's a gut punch to Upstream's old playbook. The sector's chugging 13.3 million barrels a day, 125 billion cubic feet of gas. But the merger spigot's half closed. Wall Street's rattled, deal flow's down 30%, and the Permian's not the feeding frenzy it was. For you, gas prices stay put, jobs don't surge, and the U.S. holds its oil crown, not just with a knockout punch. Call it again now. Upstream's resilient. It's a pivot to smaller plays or tech like CCS. Alaska's gas could be the wild card if it sidesteps this mess. But the boom folks hoped for, stymied. Stability's nice, but oilmen don't thrive on red tape. Mark Roach, FutureWise signing off. Keep your eyes on the rigs.